What's up everyone, it's Scotty with Money Vesting. In this video, wanted to give you a little bit of an update on where we are with this earnings season for the first quarter 2023. So I'm going to break down which sectors are reporting above estimates, below estimates, in line with their consensus in terms of EPS. And we're also going to talk a little bit about the revenue growth for S&P 500 companies and what percentage of S&P 500 companies have already reported, how much above, how much below. All that is going to be discussed in this video. As always, if you enjoy it, find it helpful, make sure that you drop a like. It's important to understand these things because we are heading into a very, very important week. We've got next week, got Microsoft, Amazon, Meta, Apple, all these companies reporting earnings. So it's going to be a little bit of an insight into what to expect and, of course, where we are with the current earnings season. So again, make sure that you drop a like, subscribe, link to our Discord, Patreon down below with that 16% annual discount available for you to access all the binds alerts, all the options alerts, trade ideas, all the member benefits, including private videos as well. And that 16% annual discount does expire at the end of this month. So link's going to be down below. So this right here is going to be that spreadsheet that I wanted to create and go over very quickly. So far we've had 18% of the S&P 500 companies already report their numbers. So if you do the math here, we've had 90 companies already reported their numbers, right, for first quarter 2023, whether it's that's the first calendar quarter of 2023, the quarter ending in March. Now, for most companies, a lot of companies, they have a different fiscal year, so it could be second, third, fourth quarter for their respective fiscal year. But for a calendar year, it's going to be the first quarter 23, the quarter ending in March. Now, in terms of companies, of those 90 companies, 76% of those companies, which is going to roughly be, if you do the math here very quickly, 90 times 76%, 68 companies, well, let's just round up here, 69 companies, so 76% of S&P 500 companies have reported earnings per share that are above their estimates, right? So in other words, they had a beat, right? So they beat their consensus estimates, which is good. But at the same time, I want to point out that the downward revisions on EPS has been pretty dramatic in the months leading up to this earnings season. So, it's just a very simple example I can give you is, let's just say that a company, 3 months ago, a company was expected to report $1.20 in EPS. Now, as this number comes down and now, 3 months later, the analysts come together and they believe that, okay, there's going to be consumer spending slowing down. There's going to be potential, probabilities of recession. We're going to lower this down to 80 cents, right? Now, if the company, this was right here, the previous estimate, this is the current estimate, right? And if the company's actual earnings end up being $1, right? Then all of a sudden they beat expectations, right? Because they reported $1, estimate was 80 cents. But that's also because we had a downward revision, right? Analysts were cutting on estimates to begin with so that companies can also beat. So that's something to keep in mind. And the 76% is slightly below the 5-year average and also slightly higher than the 10-year average of 73% as well. Now, in terms of what percentage are these earnings per share coming in above estimates? Like, what is that number? In other words, how much are we beating by? On average, 5.8%. So 5.8% is the average number that these EPS is coming above the consensus estimate, which is a little bit lower than the 5-year average of 8.4% beat and 10-year average of about 6.4% beat. So we are beating. We're beating with a smaller number, and we're also beating after the downward revisions have happened. Another thing that I want to point out is that this number right here is still as of today, right? This is the most current number that even though we're seeing about 90 companies so far, or 76% of S&P 500 beating expectations, there's a difference, right? I think we all need to understand what the difference is. Beating EPS estimates is not the same as growing on a year-over-year basis, right? Those are two very different things. One can make the stock market look really strong. The other can make the stock market look really poor. In other words, the earnings to look very poor, right? If I tell you that XYZ company beat expectations, beat their EPS estimate by 40%, right? That itself is going to start to, psychologically, that's going to start to feel a little bit more bullish, right? If you think about it, XYZ company beat their EPS estimates by 40%. That's great. But what if I then told you that even after beating 40%, they declined on a year-over-year basis by 30%? what would that tell you, right? I mean, that's the bottom line is the latter, right? It's really what matters is what happens on a year-over-year basis. Nobody cares about whether the company beats or misses EPS. The stock price maybe fluctuates after hours for 6 hours for the next day, but then everyone forgets about it. What really matters is, did the earnings grow or did the earnings decline on a year-over-year basis? That's the real question. That's the only question that really matters, is that whether revenues and earnings grew from same time last year or did they decline. Beats and misses, that's more of a Wall Street game, and that's really what happens with the stock price after hours on a reactionary basis. But that only lasts for about maybe 12 hours, maybe 24 hours, maybe a couple of trading days, but then everyone forgets about it. And then really what matters is the year-over-year growth or decline. So right now, as it stands, S&P 500 is still expected to decline on a first quarter 23 basis by over 6.2%. And we've already had about 5 sectors in the S&P 500 that have reported EPS that are above estimates. And right now, the forward S&P 500 PE multiple is sitting at over 18.2. So this right here is the number. So again, this is going over which sectors are reporting above estimates EPS in the first quarter 23. So some of those sectors are comm services, surprisingly. Consumer staples, we got energy, healthcare, materials. Those are 5 sectors that have 100% record so far into this earnings season. And the sector real estate is kind of in line and somewhat above. Financials are reporting above and below. We got IT, there's no in line, mostly above estimates, but we've also got a little bit of a below estimate companies there. And then of course we got industrials, and this is the S&P 500 on an aggregate basis with 76% reporting above estimates. We got 2% in line and 21% below estimates as well. Now this right here is going to be the revenues. Revenues, we've only got 2 sectors, healthcare and real estate, that are coming in above estimates on a 100% basis. Every other sector is struggling, with some companies reporting above estimates, some reporting below. Materials, comm services, and IT are the ones that are struggling the most, and that really are the ones that carry the most weight in S&P 500, especially comm services, because you've got the likes of Meta, Google, and IT, not to mention you've got likes of Apple and Microsoft and Tesla and all those other companies that are also part of that as well. This right here is the growth. Now, this is what really matters, as I pointed out earlier, right? This doesn't matter. How many companies are beating expectations or missing is irrelevant. What really matters is, are we growing on a year-over-year basis or not? Because that's really what at the end of the day is what critical for the market. Now, consumer discretionary is the one that's actually growing or is expected to grow in the first quarter 23. 36% growth, that's pretty strong, but then we all the way drop down to industrials, 12.5%. Energy is stabilizing here, so you can see that energy is coming off of these very strong growth rates from last year and now growing at 6.5%. And financials 5.4%, and then every single sector is on the verge of decline on a year-over-year basis. So consumer staples 4.7%, S&P 500, as I showed you guys earlier, 6.2%, utilities 11%, comm services 15%, IT over 15%, healthcare 20%, materials down over 34%. Now, this picture can and will change as the earnings season progresses. It's possible that some of these sectors don't perform as bad as what we're anticipating, and some of these sectors perform not as great as what we're expecting, right? So it's possible that a lot of things can happen. I mean, it can be a lot higher than what we're anticipating, it can be a lot lower, and same is true for some of these sectors as well. So it's going to fluctuate, but the bottom line is S&P 500 earnings growth on a year-over-year basis is what's really going to matter, and we already saw fourth quarter 22 earnings decline. If first quarter 23 earnings also declined, with second quarter also looking pretty gloomy, it's possible that an earnings recession can and will already start, or might have already started. We just don't know about it. So that's going to be a complete update on the earnings. Let me know your thoughts down in the comment section below. Next week, of course, is going to be big tech earnings. That's what I'm going to really be paying attention to at the end of the day. So I'm going to be doing some videos over the weekend going over all these different tech companies and what the expectations are for earnings. As always, if you enjoyed this video, found it helpful, make sure that you drop a like, subscribe to the channel, link to our Discord, Patreon down below. And that 16% annual discount does expire at the end of this month. As always, happy investing. I'll see you all in the next video.